I'm an investment advisor. I run my practice here in Milton on Main Street. Um, as a background, I'm originally from Kenya. So I've lived, brought up in Kenya and South Africa. So I'm fourth generation Kenyan. So I can't speak Urdu, but I can understand Urdu. So even as I'm going through the presentation, if there's any part, like sometimes I tend to speak a bit fast, if there are any things that you just want to clarify, just stop me and then I'm happy to answer those questions. So I really want to thank Dr. Shafiq, Mr. Shafiq, for firstly helping putting this together, and also Shanaz, who's part of the forum. Shanaz has worked with me for 10 years, and she's been a big part of helping me build my practice to where it is today. So I've been in Milton for about 15 years, and I've been running this practice for about 10, 11 years. Okay, so I'll go into the presentation. It's going to be about 30 minutes, and then I'll also leave 15 minutes for Q&A, but even as we go through the presentation, if there are any questions, feel free to stop me. So I'm going to start with retirement planning, and then I'm going to switch over to estate planning as well. So before I go into retirement planning, just a bit about the firm that I'm with. So Edward Jones, it's a franchise opportunity, so I own the franchise here in Milton. The branch is on Main Street. It's a North American firm, headquarters in St. Louis in the US and Mississauga in Ontario, in Canada. There's about 16,000 offices across North America. We have more than 8 million clients, and we're managing across North America almost $2.2 trillion in assets. So this was a survey that was done by the firm sometime late last year, just to talk about retirement and what retirement means for people today. And how it has changed over the years. So today, if you see retirement, the number one priority that people have is health. So that is the focus, and then there's family, purpose. By purpose, we mean charitable giving, and then there's finances. This is not ranked in order of importance, so it's not that finances is the least important, but what finances allows you to do, it allows you to fulfill all the four buckets together. Because if your finances are in order, you can maintain a good health and lifestyle, you can look after your family, pass on wealth to your future generations, as well as help the community in charitable giving. So this is a question we get very often when we're especially talking to new clients. How much will I need in retirement? So as we go through the presentation, I'm going to try seeing if I can answer this question. So very briefly, these are the types of accounts we have in Canada, which allow you to invest in the stock market, and some of the features of these accounts. So the three main ones are a tax-free savings account. So the way a tax-free savings account works is you can contribute into the account, and whenever you withdraw from the account as well, there are no taxes on any investment income or gain in the account. As an example, you put in $10,000 into a tax-free savings account. At the end of the year, it has grown to $15,000. When you withdraw the $15,000, there are no taxes on any of the gains. There is no age restriction on a tax-free savings account. The only limitation is that every year the government gives you a limit on how much you can contribute into the tax-free savings account. So as an example, in 2025, the limit was $7,000, but the limit accumulates. So if in 2025 you didn't contribute, in 2026 you might have $14,000 that you can contribute into a tax-free savings account. The second type of account is a RRSP. So what that stands for is a retirement savings plan. The biggest advantage of an RSP is when you contribute into the account, you get a tax rebate from the government. Yes?
Is there any maximum limit of TFSA?
Yes.
How much is the maximum?
So today, as of now, if you've never contributed towards a tax-free savings account, it's about $109,000. With an RSP, when you contribute money into it, the idea is that you contribute when you're in a high income earning. So say, for example, someone's making $150,000 while they're working. You contribute into the RSP. If you contribute, say, let's take an example. Let's say somebody is making $150,000. They contributed $20,000 into the RSP. The amount of taxes you would then need to pay is on $130,000. So what RSPs does is it reduces your taxable income. And then when you withdraw, the idea is that you start withdrawing when you're in retirement. So you're in a lower income tax bracket. So you contribute in a high income tax bracket, you withdraw in a low income tax bracket. That's the biggest advantage of an RSP. And over the life of the RSP, there is no taxes. So up until you don't withdraw, there are no taxes applicable. But upon withdrawal, there are taxes. RSPs do have an age limit. You can only contribute in an RSP up until age 71. Once you turn 71, an RSP has to convert into a RIF account. After that, there are no longer any contributions allowed. And then the last type of account that people generally tend to use is a non-registered account. A non-registered account, generally people tend to use once the tax-free savings account and the RSP account buckets have been filled. A non-registered account is you put $10,000, you make $5,000 on the 10,000. When you withdraw that $5,000 is taxable. So there are no tax benefits of that account. So those are the three main accounts that people generally tend to use. Some aspects that impact how people live through retirement. So firstly, rate of withdrawal. How quickly are you withdrawing money from your investment accounts? Secondly, market performance. How is your portfolio invested and what sort of returns are you making on it? Number three, retirement age and how long you're dependent on those funds. So say somebody plans to live or plans the retirement that I'm going to live till age 80, but then if they end up living 85, 90, then what happens for the additional 10 years? Are you then running out of money? So that's another important aspect. And then the last one, which I'll share an example with you, is the sequence of returns. So what sort of returns does your portfolio generate at different points in time? So I'll take you through an example. So this is a couple, Leighton and Susanna. Leighton is 65, Susanna is 63. They've done well for themselves. They have $500,000 in investments, 400,000 in RSPs, and 100,000 in tax-free savings account. They want to spend $5,000 every month. So $60,000 a year is what they want to spend. And if you look at their joint CPP and OS combined, it comes out to $3,300. So that means they need $1,700 from their investment accounts every month. I don't know if you can see the numbers, but there are two scenarios here. Scenario one, you can see the first 3 or 4 years. Hello? Hello? Yeah, so if you look at the first 3 or 4 years, the returns are very strong. You can see it's 12%, 9%, 6%, 12%. And scenario two, all I've done is I've flipped it around. So scenario two, you can see the returns in the first 4 years are not that great. There's 5% minus 3%, 2%, and 11%. And then you can see at the bottom, the returns are flipped. All I've done is I've just flipped the numbers. So you can see at the bottom, it's the same, 11, 2, minus 3, 5. And there it's... Can everybody hear me?
Yeah, we can.
Okay.
The figures are too small. We can't read it.
Yeah. I'll take you to the next slide.
Okay.
So you can see here, and in scenario two, the 10-year average is 3.2%. Okay? The middle 10 years is the same, 5.2, 5.2, and then the ending 10 years has flipped. So ending 10 years for scenario one is 3.2%, and ending 10 years for scenario two is 7.2%. But if you look at the average return over all those years, the average return is the same, 5.2%. Just by show of hands, who thinks scenario one would have done better, and who thinks scenario one would have done better? Hello? Yeah, thank you. Any guesses which one would have done better, scenario one or two? All right, I'll share the answers with you. So this is scenario one. Okay, so you can see 20,000 withdrawals. Is this what?
Yeah.
20,000 withdrawals every year, which is the $1,700 every month. Indexed to inflation, so cost of living is increasing by 3% every year. Okay, so they started with $500,000. By the time age 95 happens, because of the strong returns earlier in their retirement, at the age of 95, there's still $475,000 left, even though they are withdrawing money from the investment accounts every year. Okay, so that's scenario one. Scenario two, you can see same situation, 20,000 withdrawals happening, indexed to 3% inflation. But because the returns were lower at the beginning of the first 5 years, in this case, the couple runs out of money at age 92. So this just goes to show how important it is to be properly invested, even when in retirement. Okay, this is another very important factor, taking inflation into account. So inflation is just the cost of living. So we've all experienced it in Canada over the last 3 years. Cost of living has increased so much. Groceries 3 years back is now a lot more than what it costs today. So this is an example. So in 2025, milk today is $6.63. By 2050, that same milk will be $13.88, assuming inflation continues to increase by 3% every year. So the reason why I bring this up is because if your money is just sitting in a bank account and it's not really doing anything for you, over time, because cost of living has increased, your money will not be able to buy the same things for you in the future. So you want your money to grow as well and to increase faster than the 3%, so that by the time 2050 comes around, your money has grown to a point where you can still buy the same things. So it's very important to keep inflation into account when you're thinking of retirement. These are some of the sources of income that people generally tend to rely on, in Canada at least. So income sources, you have Canadian pension plans, CPP and OAS, old age security. Some people may have defined benefit pension plans through their work. Then your savings, RSPs, TFSAs. You may have some part-time employment income, or there might also be rental income through property investments. Some of the expenses that people tend to carry into retirement, some people may be carrying a mortgage, utilities, groceries, just day-to-day living, keeping the lights on, taxes, healthcare costs may go up, and then also as you get into retirement, you probably want to travel, entertainment, and things like that. So this is an example of CPP. So CPP is contributions that you have made whilst you're working. So every time you worked from your paycheck, you would see a deduction happening of CPP. So this is how it works out. So CPP, you are allowed to take CPP earlier at age 60, but by taking it earlier, it reduces by 7.2% every year. So if you take it 5 years earlier, it's reducing by 36%. What CPP also allows you to do, it allows you to defer the time that you take CPP by 5 years, and every year that you defer CPP, it increases by 8.4%, your monthly benefit. So if you deferred it by 5 years, you stand to get an additional 42% in monthly benefit for CPP. The way we usually recommend CPP is because, say someone's making $100,000 and they're earning $1,000 in CPP, CPP is considered earned income. So that $12,000 on top of the $100,000 is taxable. So generally, we always recommend that once you're ready to retire and there's no longer any employment income coming in, is when then you start drawing out on your CPP. Similarly with OAS, OAS stands for Old Age Security. So this is a government pension for anybody who's been a resident or citizen of the country. To get the maximum old age security, you have to have been a Canadian resident or citizen for 40 years. If, for example, you've been a resident or citizen for 20 years, you get half the amount that is eligible. Again, similarly, so unlike CPP, OAS cannot start early. It can only start at age 65, but you do have the option of deferring that to age 70. For every year that you defer it, it increases by 7.2%. So if you deferred it by 5 years, you can get an additional 36% in OAS. So that took care of the retirement side of it. So I spoke about investment accounts, I spoke about income sources in retirement. Now let's talk about estate planning. Any questions as of now?
You are talking about investments.
Yeah.
So I have to get that money out from RRSP or RF, okay?
Yes.
So once you withdraw the money from there, you get taxed on that.
Yes. Yes, that's correct. When you withdraw money from RSP, RIF, it's all taxable income. So ideally what you want to do is, so because you have no longer any employment income, so then you have RSPs, you have OAS, you have CPP, and that makes up your income sources in retirement. Because if you are contributing when you're, say, making 100,000, but now you're withdrawing, and say you're withdrawing at $48,000, that tax differential is your benefit. Okay, so for estate planning, I'll run through an example. So this is a couple, Abida and Amir. So Abida is 60, Amir is 65. Amir is ready to retire. Abida still feels like she has 3 more years that she can work. So she's going to work till age 63. Both of them are in very good health. So the expected life expectancy is 90. They want to spend $5,000 a month in retirement. So that's $60,000 a year. Again, it will increase with the cost of living. And in addition to that $60,000, they want to spend $10,000 every year towards travel. Okay, so they've done really well from an investment standpoint. You can see Abida has $510,000 saved. Amir has $416,000 saved through a combination of group plans, TFSAs, and everything else. Their expected OAS and CPP, so for Abida it's $579 a month and CPP of $869. And for Amir, since he's retiring at 65, he's going to get $500 for OAS and $850 for CPP. They also own an investment property, the market value of which is $850,000. They have a mortgage on it of $400,000, towards which they're paying $2,965 a month. They bought the property for $650,000. They're earning rental income of $3,000 jointly on, so $1,500 each. So again, from a show of hands, how many of you think they've done really, really well for themselves? Who thinks they've done well for themselves from a retirement standpoint? Yeah, so whoever did say yes, you were right. They've done really well for themselves. So you can see they start off with a retirement balance of $926,000. The blue in the graph is money from the government, OAS and CPP. The gray is rental income from property. The yellow is money from the retirement accounts. So RSPs, TFSAs, and everything else. The bottom yellow line is just the necessary spending, the $60,000 a year. The top line is necessary spending plus travel. Make sense? This to everybody? Okay? So you can see at age 90, even though they're drawing money from their accounts, at age 90, there is still $831,000 left across their investment accounts. This does not include their primary residence. This does not include the investment property. This is just investable assets. Where you see the big drop, so here, this big drop is the investment property mortgage getting paid off. And this drop is the end of their travel because they'd only planned for 20 years of travel. So those are the two drops. But as far as their retirement is concerned, they've fully met their retirement. Okay, and they've still got $831,000 left. So they're very, very excited that in addition to a primary residence that's fully paid off, an investment property that's fully paid off, we'll have $831,000 that we can pass on to the kids. Okay, so that's a very, very good situation to be in. But then what happens? CRA comes knocking, right? Because CRA has to get its taxes from somewhere. So let's run through some of the math. So they bought let's start with the investment property. They bought the property for $650,000. The current value is $850,000. Let's assume property prices increase by 3% every year from 2025 up until 2055. So by the time Abida turns 90, the property will be worth just over $2 million. Okay? At that point, upon Abida's passing, $2 million minus the purchase price of $650,000, which is a gain of $1.4 million, is capital gains. So that $1.4 million is taxable. The way Canada works, 50% of that is taxable. So 50% of the entire gain of the 1.4 million, which means 700,000 of that is taxable. At 53.3%, the tax on the $700,000 gain on the property will be $373,000, is how much taxes they would owe on the investment property. Now coming to their investment account. Of the three accounts there, a RIF account, a tax-free savings account, and a LIF account, only the tax-free savings account are not subject to taxes. They are the only accounts that don't go through the estate. The RIF and the LIF, a combination of that works out to $731,000. So it's very.
Can you please explain a little bit what is LIF?
LIF is a life income fund. So when someone has a pension at work and they move that over to an individual investment plan, it moves into a life retirement income. And then when it converts at age 71, it becomes a LIF account. So it's very similar to how an RSP converts into a RIF, a LIRA converts into a LIF. So if you had to exclude the tax-free savings account, there's $731,000, which is in RIF and LIF. That entire $731,000, it's very easy when one spouse passes. When one spouse passes, as long as there's a named beneficiary, the money goes onto the second spouse. It rolls over to the surviving spouse. But upon passing of the second spouse, that entire $731,000 is considered earned income to the estate. What that means is CRA assumes that $731,000 has been earned by one entity. So that is taxed at the highest marginal tax rate of 53.3%. Okay, so the taxes on $731,000 would be $389,000. Okay, so the total taxes that this couple would have to end up paying is $373,000 from the property and $389,000 from the investment account. So total taxes payable $762,000. Right. So if you look at this slide, they initially thought that they were going to leave $831,000 of cash to the next generation, but of that liquid cash that's available, pretty much 90% of it is gone towards paying taxes. So with proper estate planning, you can't fully eliminate all the taxes, but you can reduce it by a significant amount. Okay. Now going into some of the key elements that everybody should consider when talking about an estate plan. So the first one is a will. So will is where estate planning starts. It's I would say the cornerstone as far as estate planning is concerned. If somebody passes on without a will, it's called intestate, which means that provincial laws take over. It's usually a very big nightmare when someone passes away without a will. It causes a lot of administrative expenses, delays, money can be frozen in accounts for a very long time. So very important to have a will. And what the will also does is it names an executor. An executor is basically someone who's responsible for distributing your assets to your beneficiaries, pay debts, file taxes, and everything else. So as an example, if someone dies without a will, but has a spouse, but no children, all the money by provincial laws goes to the spouse. If there is children and a spouse, first $350,000 goes to the spouse, the balance is split a third, two-thirds. A third to the spouse, two-thirds to the children. Okay, this is something that I've been seeing more and more of. Digital assets that people have not been considering in their wills. So today, people who have credit cards, they've accumulated a lot of points on their credit cards. People who have air miles, when you go grocery shopping, you build up points. So as an example, like say you have PC Optimum points. All of those are considered digital assets. So this is becoming increasingly important, but is not being included in the will. So what you want to do is you want to create a list of all your emails, passwords, banking information in a safe and secure way, and have this accessible. Now, like Google, Apple, they're also allowing you to add legacy contacts on your phone. So it's important to update that as well, so that your executor doesn't have difficulties in accessing this information. So one very simple but often overlooked method of avoiding probate and avoiding money going through the estate is by just naming a beneficiary. So beneficiaries are very easy to name on registered accounts. So all RSPs, RIF, LIF accounts, if anybody has insurance policies, they all you can designate a beneficiary to all those. So it's very easy. So once you name a beneficiary, then the money doesn't go through the estate. And if it's a non-registered account, then ideally how you want to do it is rather than owning a non-registered account individually, because if it's individually owned and you pass, the money has to go through the estate, you add it as a joint owner. And by joint owner, what I mean, joint ownership with rights of survivorship. So when one spouse passes, the money automatically rolls over to the second spouse. A very easy way of bypassing probate and estate.
I have a question.
Yes.
The will has to be registered through a lawyer or even handwritten works.
You can have a handwritten will. Again, the recommendation would always be to have a will written out by an estate lawyer. But you can have a handwritten will, and it will still apply in court as long as it's a will which is signed and there are witnesses to the will as well.
As long as it has been notified,
Exactly.
notary public.
Yeah. And then this is what is probate? So probate is money that goes through the estate. So what a probate does is it's a document, it's a certificate from the courts that allows your executor of your will to distribute your assets as per your will. So somebody dies, money gets there's money all over the place, and then the executor applies for a certificate of appointment to the court. The court grants the certificate of appointment. The executor can then go and start distributing assets as per your will. So there are probate fees in Canada, in Ontario. Anything less than $50,000 of estate value, there's no probate fees. Anything more than $50,000 attracts a 1.5% probate fee. So again, simply adding beneficiaries, reviewing your beneficiaries, adding joint owners to your accounts can all bypass the probate fee. Another important document, so whenever you go to a lawyer, to an estate lawyer, to prepare a will, they will prepare 4 documents for you. So one is a will. Within the will, there'll be an executor named. The second is a power of attorney finance. The third is a power of attorney personal care. And the last one is a healthcare directive. So those are the 4 documents that come as a package. So power of attorney finance, so this is somebody, so a will takes over upon somebody passing, an executor takes over when someone passes. Power of attorneys are applicable when you're still living. So power of attorney finance or a power of attorney personal care is someone that, so for example, if someone cannot make any decisions because of mental capacity or for whatever reasons, then the POA finance would be responsible for managing financial affairs on your behalf. So a simple example, John suffers a stroke, but because he has a POA finance, his daughter can go to the bank, provide that document that I'm the POA finance for John, and she'll be able to manage all his personal expenses, manage the hospital bills and everything else. Whereas if there was no power of attorney, this would have to go through the courts before somebody was granted access to the bank account. Similarly, for power of attorney personal care, so this is somebody who can make healthcare decisions on your behalf when you're unable to make healthcare decisions. Somebody is shoveling slips on the snow. You have a power of attorney personal care. This person can arrange medical, get somebody to come in, look after you. So that's how a personal care attorney works. And then the next one is a healthcare directive. This is usually just a 1-pager, but what it does is that it outlines your medical wishes without causing the family too much trouble. So things like, how do you feel about life support, pain relief, organ donation, all of those outlined in a healthcare directive. So when it comes time to make those decisions, the family, there's no conflicts within the family. It's very easily stated in that document. So in 2022, there was something called a trusted contact person that was introduced by the Ontario Securities Commission. And the reason this was introduced was because there was increased amount of senior fraud happening. So you can see there was 530 million of financial fraud that happened in 2022, more than half of which was applicable to seniors over 60. So OSC, which is Ontario Securities Commission, came up with this term. So what a trusted contact is, so if you have investment accounts, name a trusted contact on those investment accounts. By law, we as advisors aren't allowed to disclose any information related to your accounts to the trusted contact. So we can't talk to them about how the portfolio is invested. We can't talk to them about how much money you have, none of that. But it's more so as a security check. If we have to take an example, if somebody was only withdrawing their RIF amounts every month, but then suddenly we started getting requests, hey, like we need $10,000, and then after 2 weeks again we need $15,000. So withdrawals which are out of the ordinary, at that point we can always reach out to the trusted contact and just find out what was going on, and if those withdrawals were actually true or fraudulent. So it's like a security, it's a check and balance, and an additional safety layer. So that was the majority of the presentation. The last 2 slides I have are a bit more, it's a bit more complex as far as financial planning is concerned. These are what we call trusts. So there are 2 major types of trusts. So I won't spend a lot of time on them. So the first one is an inter vivos trust, which is a living trust. So this is a trust that you create whilst you're still alive. So somebody has multiple properties, a lot of wealth as far as investment accounts are concerned, they can transfer that money into a trust. The advantage of a trust is that it bypasses probate, it bypasses the estate, and money gets distributed to your beneficiaries. And you still have control over the trust for as long as you're living. And the second one is a testamentary trust. So this is a trust which you would indicate in your will. So upon passing, a testamentary trust is set up. So this is after death. A testamentary trust is set up, and all your assets are transferred into that trust. This is usually used in scenarios whereby if you have dependent children, or if you have children that you're not comfortable giving in all the inheritance at once, and you want to split the inheritance over time. So as an example, you're like, okay, I want 1/3 of the money to go in at age 25, and then I want the second third to go in at age 30, and then the last portion at age 35. You can then have the trust, you can have instructions in the testamentary trust to do that for you on your behalf.
Is
Okay.
there any tax advantage by transferring all the money to the trust?
Yes, so it makes sense at a certain point in terms of wealth, because trusts are a bit more expensive to maintain and manage, because you have to appoint a trustee who then looks after the trust. The tax advantage of trust is that every year, whatever income the trust generates, so you have $1 million in a trust, $100,000 is generated as investment income in that trust. That $100,000 every year can be distributed to the beneficiaries, and you're taxed on your own capacity. So if I'm a beneficiary of the trust, I have no income besides the money coming from the trust, then that's my only income source. The only thing that something that CRA changed because they realized that trusts were attractive from a tax standpoint, is they have something called a deemed disposition rule. So every 21 years that a trust is in existence, all the assets in the trust every 21 years are considered to be fully sold, even if you don't sell them. Okay, so if your assets are held in the trust for 21 years, and after 21 years the trust still exists, all CRA will come and say that, okay, all the assets are assumed sold, so you pay the taxes, and then the cycle starts again. And then just to end off, so estate planning is not a do it once and forget about it. It's important to continue to update it, to look at it every now and then. We usually recommend every 3 to 5 years, or if there's ever a major financial change that happens in your life. So for example, birth of kids, if there's disability, if there's a move. So say for example, your child moves from Canada to the US, that's a big life change, and if that child was named as a power of attorney on your documents, then that's something that would raise an update. So it's important to always look at these on a regular basis, again, 3 to 5 years, or anytime there's a major life change. And yeah, those are my details. There's an email address, there's a phone number. Shanaz is part of the forum as well, so if there are any questions that needed to get passed on to me, and if you can't reach me directly, you can pass them to Shanaz and then she can route them to me. And again, from a consultation basis, if anybody needs any consults or anything like that, there are no fees or charges for anything like that. You can have multiple meetings. We only earn when a client eventually decides to sign on, and once we start managing an investment portfolio. But up until then, there's no fees applicable.
Thank you.
Thank you so much.
Thank you.